I'm recording it now.
Okay. So, Harish, are you okay? Are you ready?
Yes, I'm ready.
Okay. So, good afternoon, all of you. On behalf of New York Kannadakuta, I want to welcome Harish Kadlabalu, Gopal Subramaniam, Shivkumar to run this financial wellness discussion. Harish, it's all yours.
Thank you, Badri. So welcome everyone. This is a discussion on financial wellness and related matters with our own Gopal and Shivkumar. Gopal and Shivkumar do not need any introduction whatsoever, but I'm still going to harbor a little bit of an introduction. Gopal is Gopal is professor at Queen's College. And he is a lifelong investor. One of the things I can say about Gopal is that in addition to being an investor, he is actually a very curious person in matters related to financial markets, global trends, macroeconomics. So as you will see today, he brings a wealth of insight and knowledge into the larger forces that are shaping the economics today. And our own Shivkumar has been in the financial industry for many, many years, many decades, and he has amassed a great wealth of experience and insight in how the markets work. He works at S&P as a senior director. So he brings an industry perspective that is very valuable for this discussion. And I have no qualifications. I'm just a moderator. Very quickly, I want to set the stage a little bit on what this discussion is really about, and more importantly, what this discussion is not about. And before we get there, we have decided to have this discussion in English. The reason being we have invited many people who do not have a fluent knowledge of Kannada, and we want the matter to be them as well. So what this discussion is about, my request is if you could keep yourself mute for the duration of the meeting. So what this discussion is really about is to get a perspective on the trends and the forces that are shaping today's economy and market. There's a lot of anxiety on what is going on. We all
everybody. I want to say everybody. No, not friends. They're.
Hold on. I'm going to have to mute everybody. Okay. So this is an effort to get a higher level perspective on the market. We'll also discuss about where things are headed and how we might figure out a way to navigate this journey. What this discussion is not about is giving out or discussing.
Wait, could you start this again?
I'll take the task of muting Harish.
Could you, could you mute people as they come in? Thank you. So what this discussion is not about is giving out specific stock tips or discussing opinions about any specific investment vehicle or anything like that, or tax advice or business advice and so on. And the simple reason is that none of us on this call are professionals. So do not make any purchases, any sale or any financial decision purely based on this discussion. This discussion is really just giving a bit of an overview and a perspective. So during the discussion, please use the chat functionality in Zoom to input any questions you may have, and we're going to collate them and try and cover as many of those questions towards the end of the presentation. And last but not the least, we're going to share this deck and possibly the video also through Kannadakuta channels, either on YouTube or some other way. So you do not have to rush to grab a pen and a paper and take notes or take screenshots or anything like that. So with that, I'm just going to start with Gopal. Welcome, Gopal. Could you start us off with a sort of a high level overview of the macroeconomic trends that have happened since the, I guess, the inception of the market and where we find ourselves, with special focus, I guess, on the current anxieties?
Thank you, Harish, for introducing. First and foremost, I have to thank you for actually putting up all the slides. So it's something that you bring a lot of wealth to these discussions. So you are very important with a lot of technical knowledge and also with a lot of knowledge about the companies. That said, I am also not a professor of economics, neither macroeconomics, nothing. So it's all out of interest, and I try to put things in some sort of a common sense. So see what we can understand from this. So what we are really seeing is a graph which shows how has the S&P behaved over nearly 100 years. Is this the first unique situation that we are seeing? Has there been many situations like this? So it turns out that we had like a Great Depression in the 20s, and we had several events. We had wars, we had the stock market crash in 87. We had a crash in 2001, that 9/11 event. We had another event which happened in 2008 or 9, which is, I think, fresh in everybody's memory. So all these events cause temporary crashes. And as the graph shows, that the overall market always tends to come back up. And somebody always used to tell me, like when I was starting to invest in, I bought my first stock in 1990. So one person told me, don't fight with the Fed. So the Fed prints money. So you don't fight with the Fed. They are there. They are going to save us. And they're never going to let the market go down in the long run. So that is one thing for sure. And it has happened. History has shown that. So first and foremost, take away the fear. That's what history has shown us. So, from what we see here, this is what is happening. And of course, you're always going to have worry about a short term. There are also long-term things. There is also worldview, so many things to worry about. So let's have a look at that.
Yeah. So Gopal, is it fair to say by looking at this graph that over a long period of time, even though there have been, stock market crashes, just as often as there are rallies, the general trend has been for the market to go up. So with that, would you say that it is better to stay invested?
That's a very interesting question. Okay, so what would you like to do now, and how do you really you play this whole game? Should you be invested 100%? Okay, the first and foremost thing is you need to have a discipline, because you don't want to stay uninvested at any point of time in your life, even when you are very early and even when you are very late. So what I would say, the key thing, as the title says in this slide, discipline and practice. Okay, when do you start? You want to start as early as possible. We put here 20 and 25 thinking that somebody will start working at 20 and 25. Nowadays people start working even when they're in school. So the investing starts very early on. As soon as you get your first paycheck, first set of money, go ahead and start investing. There are, of course, like you don't, even at retirement, you still want to be invested in the stocks. But what happens? Why are we constantly worried about this? There are two important factors. I have gone through them. I'm pretty sure many of you, or some of you, and some haven't. Greed and fear. What happens is when the market goes up, we start chasing it. We see somebody, some friend, who made a lot of money, 100% return. Or, we have, something that the stock keeps going up and up and up. It gets written about in a newspaper. and we want to go and buy it. So the buying always happens when an event which has no connection to the actual fundamental value of the stock, and you keep buying it. Greed-based buying. Selling, the same thing happens in the opposite direction. You're very fearful. And the most important thing about selling is that when the market goes down and you see the value of your money drop so fast, your stomach starts churning, and you really cannot, handle that. The huge losses. You basically sell in a panic because you don't want to lose your last bit of money. I want to run away. And believe it or not, I have had this factor from so many of my friends. And during the 2001 9/11 crash, as well as at the 2008 crash, many of my friends have come and told me that they are completely bailing out of the market. And I have to tell them, please don't do that. Stay invested, So the thing is that discipline is a key to having a peace of mind. That discipline. You don't sell in greed, you don't buy in greed, or you don't sell in fear. So how do you, the most important thing is have a very, very strict discipline and start practicing the discipline. Second is, if you are, investing in individual stocks, that is always going to take a lot of research and it needs to be practiced. And there is always a lot of risk involved in individual stocks. So we could look at overall stocks and we can about individual stocks. I'm going to leave the individual stocks and picking that part of it to Shiv Kumar. So I will tell about in more broader terms. Okay. So
yeah,
we can, yeah.
Thanks, Gopal. So in the current situation, though, just staying with the macroeconomic situation, in the current climate, the Fed has injected a lot of cash into the market, and there's a lot of stimulus. There's enough spending that is going on, right? So given that, everything is going to be okay, right? Is everything going to be back to normal soon?
That's a very interesting question. It's like saying that I can always borrow my way out of my current difficulty, right? If it is that easy that I can keep on borrowing money and take myself out of debt, there is a problem with that. Look at this particular graph. It shows you how much of money that as a country we have borrowed. Well, you can borrow money, not a problem. You can borrow money as long as your revenue is going to be higher than your borrowing. This particular graph is showing you that our revenue is not going higher than our borrowing. So the debt to GDP as a country, like this is our debt, and the GDP stands for the gross domestic product. It's like mostly, think of it more like your income and expenses. Debt is your overall, I shouldn't say expense, the expense above your income. And that is represented as a percentage of your income. Right now, more than 100% debt level that we are in right now. For the long time, the debt levels was only like about 50 to 60%. And suddenly we have jumped very, very high. So it's like, how long can we keep on doing this? Can we increase our debt and still stay the same?
Well,
who is going to give this money to us?
Right. So, but I also noticed that the graph only goes up to about 1999. It doesn't capture anything at all about what's going on. So, where is this graph going to go with the new stimulus and other spending that are imminent to prop up this market? Where do you think this is headed?
Well, two things have happened recently. One is our Fed has borrowed another $2 trillion. I think everybody knows about that. And the $2 trillion is also followed by another $2 trillion worth of lower revenue. So when you have a lower revenue by 2 trillion and increase your debt by 2 trillion, the difference is 4 trillion. So our debt level is going to go up by $4 trillion and that represents approximately 20% increase in our 2020 debt to GDP ratio. So we'll have a spike.
It's going to be
In
around
fact,
130
yeah.
or 140.
It's right now around 110, close to 110. It's going to go up to 130 debt to GDP. So it's a serious issue because we are continuously going to have debt.
Right. I mean, there's nothing we can do now, right? I mean, this is the situation we find ourselves in. So, but
You know what? There is going to be a problem, but the thing is that we print our own money, so we can keep printing it. That's a good thing.
that's
But
a good,
it's also a bad thing. Yeah.
good to have a printing press.
We have a printing press.
So,
Yes.
but this is a worldwide phenomenon, right? I mean, I understand that this is the debt to GDP ratio alone is a factor for our own future prospect. I understand how that might be happening, but if this is since this is a worldwide, phenomenon, how do we compare the rest of the world with ours?
Yeah. I mean, let's just do that comparison. Like see where do we stand in comparison to other countries? In fact, those of you who follow the macro trends probably know that Japan, which is all the way on the top, has 237% debt to GDP ratio.
Wow.
Yeah, it's the topmost. And that is, and there are many smaller countries like Sudan and all those countries which we don't even care about. But there are some countries like Greece, which is the third in that graph, have very huge levels of debt. Other than the Greece, we have Italy, Portugal. There is also Spain in that whole graph, which is somewhere towards the bottom. Remember that we only plotted so many countries which are on the highest debt levels. So if you look at this, US is somewhere there in the middle, amongst the top countries, of course. But some of the countries in that list, we already know Greece, Italy, and Portugal, as well as Spain. These are commonly called as pigs.
Yeah.
Those countries had a tough time recently after the 2008-2009 crisis.
In the last 10 plus years, they have not done well, even though they have just, sort of remained afloat. But, we hear bad news about Greece and Italy and Spain and Portugal all the time.
Exactly. They had a lot of exodus of people. So it's really, really a bad thing to have too much of debt. That's for sure. And one of the ways, so basically, debt is a very, very serious problem for many of these countries. And the debt is going to be a serious problem for us if we don't take care of it. We can continue like this for some time, but we have to really match up with something else.
Yeah, I mean, we'll also talk about what this means to us personally in a second, but can we take maybe just two of these countries and just try and understand how relatively they have behaved?
Well, particularly you can actually look at how the stock market performs for these two countries. The best comparison you could give is between Greece and Germany, because Greece and Germany are part of the same union. They are part of the European Union. They have a common currency, which means that neither country can print their own currency. Okay, this is a very important point between various places. Greece and Germany cannot print their own currency. They have to use a common currency. When you have to use a common currency, you can see the divergence in the stock performance. Greece, because of their huge debt, were never able to come up after a crisis. The 2008 crisis simply put them down. Germany, on the other hand, is able to come back up after the crisis because Germany's debt level is much, much lower. So from a macro standpoint, if your debt level is lower, you generally can borrow money. If your debt level is very high, you're basically maxed out your credit limit, so you cannot borrow money because you have to borrow money in a common currency. Remember, you cannot print your own currency. So when you cannot print your own currency, then those countries go into serious issue. No matter which country you're talking about. Here is another example. USA and Japan. USA and Japan, the big distinction, both countries can print their own currency. So even though Japan had a huge amount of debt and the US also had a huge amount of debt, both countries can print their own currency. But what it shows on the divergence is USA kept increasing the debt, but USA also had a growth in their GDP. Japan, on the other hand, had a stock market high in 1989. 1989, the Nikkei index went up to 39,000.
Wow.
Very, very rapid race during that time, and then it fell.
Yeah.
It has still not reached that peak. Their GDP kept going down, but their debt could not be done anything with. In fact, they tried to stimulate the economy like the way we have been doing, but they could never stimulate that economy. The GDP kept going down, so the debt kept on increasing. So they actually had a lower debt also at that time, but then because the GDP was shrinking at the very same time, the debt level was increasing. They have a very, very huge debt level right now.
Right.
But again, they didn't go along the direction of Greece. They did not go along the direction of Italy or any of those countries, mainly because the debt of Japan is printed in yen. And the debt of USA is printed in dollars. So the only way they can take out debt is by different methodology. They cannot file for bankruptcy. They don't have to worry about borrowing from outside to take care of the debt, but they have to do something still to take care of the debt.
I see. So basically, they depreciated their own currency.
Right.
So sorry, one question. In European Union, who can print the currency? Is the European Central Bank or any?
Sorry, what?
In the European Union, is it the European Central Bank who prints the currency, or it's the?
Yes.
Yes. Okay.
Exactly. Yeah. The European Central Bank is the one who prints the currency. Everybody has to go with obviously the euro, right?
Right. Yeah. Right.
Yeah.
Thanks.
Gopal, this is Gopal. Just I have one. Gopi. I have one question. Like borrowing money. You're saying I hear like we are borrowing from China so many trillions of dollars, and you're saying borrowing is also printing. So I am confused. Who is going to give the money for Americans? If it is borrowing, means are we printing? Are we getting it from China? Or like I have.
We are actually not technically printing the money. We have the ability to print the money. That's what I meant actually. Japan, for example, the entire debt is owned by the people. Almost 90, I don't know the exact percentage, a large percentage of the Japanese national debt is owned by the people of Japan. Instead of investing money in a Japanese bank, they are basically investing it directly in the bonds of Japanese, the treasury. The same way the US treasury, a significant portion is held by the US citizens, but in the US at least, a lot of the debt is also owned by foreign countries. China is one of the biggest holder of US debt, but still the US citizens owns most of it. And if the Chinese decides to dump their treasury and sell it, and there'll be enough buyers in the US to hold on to that. It's always like a situation where they can always print more money if they want to, but as long as people are buying the US debt at 0.5% interest or even 0% interest, just give it to them. That's it. So they don't have to borrow from another country or a European Union or anywhere else to pay the debt. You owe it to your own citizens, so it's not a problem.
Yeah. So may I request one thing, Gopal, and the rest of the participants? Can we make sure that the questions get into the chat feature in the Zoom? We'll have plenty of time in the end to have specific discussion on the questions, and then we'll aggregate these questions ahead of time, so we can sort of have a more systematic discussion rather than jumping in the middle.
Just want to say that we will not go the line of Greece or Portugal, mainly because of the fact that our debt is denominated in US dollars. So basically, as a Federal Reserve, we can control the value of the dollar. So therefore, one need not worry so much about the debt. You have to worry some. So I just want to say that difference between the two.
Okay, thanks. Now, this is more like, these are the situations at the level of the country stock market as a whole, right? But what does it mean to us as individuals, right? I mean, what does the national, quote unquote debt mean to us?
Okay, yeah. So we can actually convert this debt to what would it look like per person. So I guess we can look at it like as an individual, how much do I owe? As soon as you are born, if you are born in 1990, the amount of money that you owe, the mortgage, you can think of it like that, is about, $12,000 to $13,000. Today, if you are born, you can expect to owe $70,000 in loans. That is the amount of money, that is the debt that we have divided amongst each citizen. So we owe 70,000. If you really look at the inflation, the money didn't grow that fast. But in terms of our debt level, you can see how our debt level has really gone up that much. So right now, we are very happy to receive a $1,200 check for every individual. But even that check, added to that is another $4,000 worth of debt to us, which we have to repay. So it's it's not really like a free money. It's just divided amongst people, and that money keeps growing higher and higher and higher.
So
it's a lot of money.
What I'm saying is that if any child born today has a mortgage of 70,000, if not more.
Yes, $70,000 in mortgage. Not a small number. That's a pretty huge number for each person.
So how will we ever pay this back? Like, what is the mechanism? And is it going to be deducted from our salary? And how does it work?
Well, obviously, we cannot pay this money in one shot. That is for sure. And also, there is no way, well, there's like a lot of talk about if you raise taxes, there's a lot of a problem. So what could really happen is, one is the nation will try to pay it back without raising taxes as much as possible. Mm-hmm. But can they really do it? Well, two things. One is, if you start borrowing too much money and somebody can lower the credit rating, the S&P, where Shivakumar works, can say, we had to lower the credit rating. And in the past, the 2009 crisis, actually the S&P lowered the credit rating for US. They only had to reverse it a little bit later on. So the credit rating could get lowered, which means that we have to pay a higher rate of interest, which means more of our taxes will go towards paying the interest. If more taxes go towards paying the interest, then they have to pay less money for services. And which one they're going to cut? The biggest expense for the US government is not welfare. The biggest expense for the government, 50% close to that, is spent on Social Security and Medicare. Without cutting that, they cannot pay interest. It's just not possible. One might say, okay, all right, let's say they don't lower the credit rating. Why can't we continue to borrow more and more and more money? Well, we can continue to borrow more and more money, and which in case, when we keep on doing that, then the foreign corporations or foreigners who are buying our US debt may stop buying it. More of our money has to be bought locally by the local citizens. Then in that case, our own corporate companies like Boeing, for example, when they want to go and borrow money, there'll be no money for them, because we will rather loan money to the government, which will have a much higher credit rating than the Boeing company. So which means that Boeing cannot raise money to do their operations. So reduced economic activity also leads to less employment and less social security and so on. So the bottom line is very clear. Future social security and Medicare is going to be much, much lower than what it is today. This is the price that we are going to pay for having that huge cost and continue to spike it up. There is, I would say, anybody who is born today has to assume that the Social Security and Medicare will not exist when they are going to retire.
will not exist or will have lower returns?
Well, I can't really predict for certainty, but I am going to assume that it's going to be extremely low, or it is going to be pushed way past, like 75 or 80 or something like that. No matter what, if you are very young, if you are going to be starting out, assume it is not there and do something about it.
So basically, the net of it, what you're saying is that because of the coronavirus, worldwide coronavirus outbreak, the tumult that we have in the stock market has to be filled, has to be supported somehow, right? Through stimulus, through other means. But that doing that itself, we don't have a choice. We have to do it. But doing that itself has long-term consequences. And what you're saying is that the long-term consequences for us as individuals is likely to show up in reduced Social Security payments and Medicare reimbursements over time. Is that a good kind of summary?
There is the possibility is that they'll be start slowly moving the goalpost from 65 to 67 to 70. So there's it's going to be like a various combinations. It might not disappear overnight, but it'll be slowly going to be reduced.
I see.
So yeah, my thought about this is that it's not like you don't want to that you don't want to really say it's going to be there and plan for it. I want you to plan by saying that it will not be there.
I see.
So plan. Say yeah, it's good to plan like that way. And if it is there, think of it like a bonus. It is there. If it is not there, then don't worry about it because you'd have planned for that anyway. And remember, this coronavirus is not going to be the only thing we are going to be having. We are going to be having another virus attack in 10 years or so. We may or may not be prepared for that. The crisis is going to be coming. And that crisis, every time you start with a debt and you have a crisis, the debt will continue to go up.
So what do we do as individuals, right? I mean, we are not the Fed, we don't run the government. What can
we have only control over what we can do, and we can only to a level we can actually plan for that uncertainty. Anything which is going to come from the government, think of it like a bonus. Like, we get a $1,200 bonus. Okay, it happened. Great. So like that. So the key thing I would say is, take it, even no matter what advisor you go to, no matter what the government says, no matter what the social security platform says, I'm going to say that you ought to assume if you are going to be in your 20s and 30s, just assume it is going to be reduced significantly. And save more for that. Save more right now when you have a chance, particularly when you're very early in your career.
I see.
Okay. So, that said, now that we are thinking about saving, where do we save?
Yeah. So that's sort of the jumping off point, right? But before we do that, where do you think where are we headed? Like, what is the future actually going to look like?
Well, if I have a crystal ball, I can tell you exactly where it is going to be. It's extremely tough to make predictions. How long, how much? There is, the Dow can go to 40,000 within 10 years or within 15 years or within 5 years. But the general trend is always going to be higher stock market. However, it's not possible to predict, particularly the immediate one. So what you can say, based on the, whatever has happened, you can say that we are going to have some sort of, a market low, but the fluctuations will always going to be there. So what you want to do is, you don't want to be caught at the wrong time in the fluctuation cycle to retire. So particularly when the fluctuation is going to be going down tremendously and you have to retire at that time, you're going to have a serious problem, right? So we want to see, what is the best way to mitigate that? And it turns out that we are not going to be, you don't want to be in 100% stock market. there are different kinds of assets, particularly the bond market, the gold, oil, and the commodities, or even the world stocks. Some of them are independent of each country. Some of them are going to be, very different, very much away from world catastrophic events. So, for example, even in the recent downturn, some of them tend to do in an opposite direction. So you basically want to have a strategy where your assets are diversified so that you can have a peace of mind. You don't have to plan your strategy at every single time there is going to be an event. Neither we can predict the event, nor we can predict how everything is going to behave in an event. So let's just look at how these different asset classes behave. And and I think I'm going to show you a graph where how the different classes of assets behave. And there are many ways you can think about the asset classes, but these are the ones which are specifically designed for showing the correlation between the rapid movements of the stock market versus the very, 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 very tiny movement in the T-bills, the treasury bills. So we have kind of put this idea about cash. Here is cash does not mean putting the cash in the bank, because the cash in the bank is actually extremely 0% interest. It's not going to have anything. Normally, cash is considered as your 3-month treasury bills. Bonds are a little bit longer term duration. Again, both this cash and the bonds are guaranteed by the government. Remember, the money that is you put in the bank are only FDIC insured, but if it is a T-bill, pretty much it is completely guaranteed by the government. So short-term T-bills are more like the cash, with a guaranteed rate of principal and the interest. So safest investment is that. And as you keep moving from that, the cash bonds and the corporate bonds, then comes the gold. The gold is, for example, completely independent of any country. For example, any catastrophic event in one country or anything will not be affecting the price of gold. Then the real estate is mostly commercial real estate, which usually have a slightly different correlation from the stock market movement, because the real estate, commercial real estate, tend to lag the market a little bit. And then you have both non-US stocks, so these are world stocks, as well as the stocks of US are on the riskier side. And if you can look at, for example, a very specific location like 2001 and 2009 crash. I think the 2009 crash is very visible and nearly everyone remembers that. The US stocks and the foreign stocks both went down in that same year, 2009. I think if you can show that 2009 stock market crash.
2008 crash.
Yeah, 2008. Yeah, that was the movement. And that time, if you look at that one, there are a bunch of other investments, including the bonds, the cash and the bonds, for example, actually went up. Yeah. So there is a reverse correlation to those conservative assets during the time of any catastrophic events.
Right. But it's not entirely guaranteed either, right? Because there are times when both have gone up and there are times when both have come down. There are different
usually the short-term cash never goes down. The short-term cash is always very conservative, but the intermediate and the long-term bonds tend to have a slightly different reaction.
Okay. Just to clarify, Gopal, what we are looking at this graph here, and this graph is a little bit hard to read. What we are looking at here is really growth year over by year by what we have divided them as asset classes. These are not absolute numbers. These are just percentages of growth. So just to be
right. This is in a way it's a little bit misleading. All I would want to see in this graph is look at the zero line and see the things which are below the line and things which are above the line. That's it. You don't want to look at everything in this. It just shows you that certain asset classes are above the line, zero line, and certain asset classes are below the zero line.
Okay.
The most important thing is that so not every asset class move the same way. That's what we want to show here, is that there are sometimes one asset class may be going below the line and a bunch of other asset classes will be above the line.
Yeah.
So even in the worst scenario of the 2008 crisis that we know of, some asset classes were below the line. Even in those times, some asset classes were above the line.
Right.
So that is the key thing you would want to take from this graph. And there were I would say like about 6 or 7 years, even in this 20-year graph, when the stocks were underperforming. So even in those years, there are other groups which were performing better.
I see. So I'm just looking at this graph, right? Gopal,
yeah.
Without sort of straining our eyes to figure out which color is where. Why wouldn't anybody just stay with the safer investment? So what stops somebody from just putting everything in cash or maybe just bonds? I'm just right through, because if you look at this, there have been, just by kind of color eyeballing it, there have been growths in bonds. Maybe there have been a slight, growth in, I don't know, cash also. Why wouldn't somebody do that?
Yeah. See, the word safer and riskier also means something else too. The risk reward spectrum, as we would want to call it as, let's say you put about $100 at the very, very beginning of this 20-year cycle. Okay. I think it's, is it 40 or 20? I can't read the number correctly on my graph.
It starts at 1980.
1980, right?
40 years.
Yeah. 1980 all the way up to 2019, till the end of last year. And as you can see from the graph, the best performing one, your $100 would have grown all the way to $7,000 if you were completely 100% invested in the US stock. $100 to $7,000.
Wow.
Risk. That's why the reward you get. Do nothing. Just get into the index. Whether you have gotten the S&P index or the Dow index and kept on doing your job without doing anything, you would have had $7,000. This does not assume that you keep investing $100 every month or every year. This is just $100 one time. You put the money in the index and forget about it. You'd have had 7,000 if you just slept on it. On the other hand, if you had put it in the short term, that is a 3-month T-bill, your money would have grown to slightly less than $1,000.
Yeah.
So that is the problem. You would have barely kept up with your inflation from 80 to 2020 if you had just put all the money in only T-bills, short-term T-bills. You would have had safety, but you would have barely kept up with the inflation. So it's like not really getting a good use of your money that you can put in. So I would say the best strategy would be, if you would want to have some peace of mind, you should try to have a combination. And I would say, like, why you want to have like a combination? Just to take for example, the 2008 crash in the stock market, just as a focus point. If you look at that, the performance of the real estate as well as the US stocks, they had a huge drop in that particular year. Everybody knows about that catastrophic event. But the foreign stock market didn't drop as much.
Right.
A diversified portfolio, which is shown right there, even dropped the lowest possible, because it was capturing some of the increase in the bond, some of the increases in the gold value, and also short-term T-bill. So a diversified portfolio actually would have performed better. And if you look at the growth of the diversified portfolio, you would have gotten $4,000 or more dollars. And the fact that the way I even show the diversified portfolio is actually, it's a continuous asset diversification. It is not like, you start out with the diversified portfolio. It's more like you start out with $100 invested in stocks, but then as you age through, you keep diversifying into other assets. In other words, you want to start with the riskiest asset to begin with, and then as you grow older, you would want to reduce your risk level. So you basically keep allocating the portfolio towards others and keep reducing it. In this model that I made, this is not the model supported by any financial advisor, because they do have target date retirement funds which kind of do the job for you. In this model, I basically said, you know what, let's just start with if at 2025 you got to be 100% in the stocks. Ignore about what is happening with the coronavirus. Start with 100% stocks, and completely, as you grow next year to next year, keep diversifying into other asset classes by the way you do it is, at the end of the year, whatever money that you have, you reallocate by reducing the stock portfolio by a smaller amount. And you keep doing that over and over. Even at 65, because when you go through a 40-year cycle, at 65, you still want to have some portion in the stock market, because you are not really, ending everything at 65, unless you're going to have an annuity. So you're really going to have, if you're continuously, drawing from your retirement funds, even after 65, continue the process, keep diversifying, and keep reducing your stock-based asset class, even in retirement. So basically, you don't want to, the guaranteed Federal Reserve backed growth coming in the market to completely vanish.
I see.
And I think that is the key thing about this: discipline.
Thank you.
Oh.
And thanks for everybody who has been putting in questions in the chat. I'm compiling them, and after towards the end of this thing, we'll spend however much time is needed to go through those questions. Yeah, please keep them coming. Thanks, Gopal, and we'll come back to you in a little bit. So kind of just switching gears a little bit, just want to bring Shivkumar in. Shivkumar, again, kind of starting with where, Gopal also started with, what do you think is going on in the current market situation? And also, basically, just, help us look at the last 20 years or so. And then we'll narrow into a little bit more of the, now within the next over the last 2-3 month range. So please take it away.
Sure. Thank you, Harish. Thanks for bringing me on board on this. Well, before I tread into the current market situation, I just have to express what a year this has been, particularly the last 2 months, right? I watch the market statistics throughout the day as part of my job, and I manage the systems behind the S&P index databases that perform the financial calculations. And it's been one heck of a time over the last 2 months. So now going back to the charts itself. So if you look at this year's chart, just, over the last 3.5 months, you will see the dips in the market that caused valuations to come down significantly due to this pandemic. And that actually has pushed the markets into a recession territory. See, the recession we had, the previous one was the 2008, where during the global financial crisis, where Lehman Brothers filed for bankruptcy and Bear Stearns bought by JPMC for about $10 a share. Now that downturn happened over a few months, and the recovery took about 3 years. But this pandemic caused the downturn in just 3 weeks. I mean, such has been the panic around the markets with respect to what has happened. Now, that has not only impacted just the financial markets, but also the daily lives of everyone, right? It has changed the livelihood and the way of living for many of us for quite a while.
Yeah. So, getting a little bit, longer term view, right? Just for a moment, looking at over the, last so many years, especially on Dow. It doesn't matter, we could have done it in S&P as well. Can you comment on sort of where we are in this moment in the trajectory?
Well, so as I was stating, right? So if you look at this, look at the first depression. Now, before I talk about depression and recession, well, let me give simple terms or definitions of recession itself. What it says on the Wikipedia is that a recession is basically 2 quarters of negative GDP growth, right? And that's already expected. We're expecting this the Q1 quarter to be down about 6%, and then possibly the next one. If you had asked me 3 weeks ago, the prediction from U.S. Treasury Secretary Steve Mnuchin was we're going to be down about 20% on the GDP. But then looks like there is a potential that we could be down around 15% based on how the statistics around the pandemic is going to show up. So now so we are clearly in a recession territory. But the depression is basically what they define is a recession that's prolonged over several years, right? So the closest depression, and that's when, if you go back, we experienced in our lifetime is the one between 2008, 2008, 9, right? That was when the home price bubble happened, the home price bust and boom. That lasted about 18 months. It took about 3 years to get to the trough, but the worst one was the 1929 one. And if you go back to the chart, Harish, we will see that that was a prolonged one. It was pretty bad, and it lasted for a long time because the governments were not positioned in any way to come out of it. There was no Fed funds or anything like that. The federal governments did not act on that. The industries, there was so much of unemployment, and the industries did not bring back the employees, and there was no sort of an unemployment at the time that would help out people. So it was a very bad time, almost about 90 years ago. But now governments have learned through the mistakes that have happened in the past. And that's when you notice that during the 2007, 2008 bust, the federal governments were able to step in and help out some of the financial institutions. They came out with the stimulus, what they call the quantitative easing, and then the Fed was able to even cut the interest rates to control and build up the economy. Now, it took about 3 years to come back to the point where it started to drop from. Eventually, we have seen market growth from there on. But this one is an unprecedented downfall. So what we see here is a sharp down, and it's pretty small in this chart. But then if you look at the last 3.5 months chart, you will see that severe spike down.
Right. Yeah. Right. It's comparable to. It's definitely comparable to recession.
Yep.
Depression, we don't know.
We don't know yet. So there are several recovery scenarios being thought about. So if you look at the recovery scenarios, there have been many discussions around the recovery itself, right? So how will the recovery going to look like? One, they're saying it could be a V-shaped recovery. So we already have seen that steep down. So there is a potential for that V-type recovery, but I don't think so, because we still don't have any statistics around whether there is a permanent remediation to the pandemic solution, right, at the problem we are having. And is it going to be a U where we already have seen the downturn, it's going to be flat like that for some time and then going to go back? I don't think so, because again, we're depending on so many economic factors related to unemployment and then the finances around the whole world. Right? The L shape, I would rule out, where that means a sharp down and then it's going to stay flat like that. That's one of the things that the people faced in the 1929 crash, where there was no support or help from the government or any other means. So it stayed flat for a while. Now, what I'm thinking is that we're going to have more like a tilted W. What that means is it will be a bunch of V's, but growing over a period of time, right? That's the type of thing I'm expecting. Some analysts and the financial gurus are saying it could be more of a square root, where that means there is going to be a V and then it's going to stay flat over a period of time. That yet to has been seen based on the statistics related to the virus. So from a time horizon perspective, The best case scenario would be a downturn that is more or less similar to 2008, but a short-lived one rather than 3 years. Hopefully, we should be able to get back, allowing for a return to positive growth by the fourth quarter of this year.
Fourth quarter of this year, by the end of the year. I see.
Yeah.
I see. I see. That's the consensus view of the analysts?
Yes. As of now, they are predicting that, assuming, well, that carries a bunch of assumptions, right? That hopefully the testing kits, the diagnosis related to the COVID are going to happen over the next few weeks to less than a month. And then the statistics related to the deaths and the symptoms, if that count has to start to go down rather than, if we assume that we have already reached a peak and it's going to start going downturn, and then the different therapies that are being introduced are going to bring in some sort of remediation and eventually see that there is a permanent vaccination or some kind of a remediation by end of August, then we are expecting that by end of Q4 we could return back.
So the net of this really is that virus is controlling the economy right now.
Yep.
Yeah.
True.
Wow. Okay. Now, sort of going to the age-old question of how is it that we could create a portfolio, right? Both in good and bad times.
Yeah.
Could you sort of give some high-level advice on how each of us should be thinking about it?
Definitely. So your current age will be the decisive factor on how your investment allocation should be, right?
Corona or no corona.
Right, irrespective of corona, right? So we should have that type of a time limit. Every human being would have about 30 to 40 years of time for investment, right? So that's what, depending on the age where you are starting on investment, but not everyone is educated or not everyone is knowledgeable and aware of all the different investment strategies that they should have applied or started with, right? So there are some guiding principles and rules around that. I've also indicated that on the slide. But for some of us in our 50s, there is still time to be in the market, but we need to tread with caution on investments, right? Just know one thing, you can't time the market. However, asset allocations help, right? Try to diversify and shift your risks accordingly. In summary, I would advise you to keep a time range for your investments. A simple example, right? Imagine you invested in a good company like Apple about 20 years ago. If you had just put $1,000, okay, you will see that your money would have been around 300,000 when the market peaked this February.
Right.
But now, with Apple losing about 25% from the top, right, your 300,000 would be down to what? 225,000. But you are still in a very good place financially, right? Because your $1,000 grew to 225,000. Okay, so this also means it took 20 years on a good pick to reap the harvest. So my advice is to keep a focus on a growth plan. A well-diversified portfolio should fetch you anywhere between 12 to 15% year-over-year growth. That's what you should focus on.
Nice.
Now try to diversify and shift your risks accordingly. As Gopal suggested, you always have to evaluate and look at what would be risky and how you can protect yourself from some of the risks. So, and that's where we are right now.
Right. So in this though, to do the portfolio allocation, obviously different, asset classes or sectors of the market will all need to be taken into account.
Absolutely.
So do you think, Shukumar, that we should maybe just take a look at the last 3-4 months of sectors and how they have performed to get some insight? So
yes.
Advise on that.
Definitely. Harish, do we have that chart? Oh, okay, great. Okay, wonderful. Okay, so if you look at that, this is a chart that shows the S&P sectors performance just for this year. we're taking zero at the point where each one of these sectors, the key sectors, as you can see them listed below here, the consumer discretionary staples, energy, financials, healthcare, all these sectors, basically how they performed till pretty much last week when the market closed. You notice that a lot of the sectors, especially, let me talk about the energy sector. The energy sector came down significantly, losing almost like 65%. Now, the energy sector itself was struggling last year, especially with respect to the demand. The lack of demand and increased supplies caused the energy sector to lose most of its valuation. And many of the companies are pretty much have lost somewhere 80 to 90% of their valuation as of now. While we see that little bit of an up curve, but then this is going to be still a struggle with this pandemic. And you see that many other sectors have also come down, like the consumer discretionary, the travel, leisure, entertainment, and the gamings, and all these have come down significantly. Right? And the financials have also been bleeding, and the real estate investment trusts. But at the same time, information technology and healthcare seems to have come back up from the bottom and have significantly come up. If you look at from the bottom to the end, when the market closed yesterday, they have come back up almost 50 to 60%, right? And that mainly is because from an information technology standpoint, everyone knows that artificial intelligence, natural language processing, automation in many industries, okay, has brought in so much improvements in the economic growth that the technology sector is going to continue to grow irrespective of where the pandemic is going to take us to.
Right, yeah. Yeah, no, that makes sense. It's also important, I guess, to note that some of the sectors didn't really fall all that down, right?
Good point, Harish. Yeah. Well, there are sectors, well, from an economic standpoint, we call what is called the essentials and the non-essentials, right? So the essentials are something that's necessary for every human being to survive and tread through their life. And those, the production related to agriculture, goods, retail, and some of the sectors which provide day-to-day activities, including healthcare, have stayed steady.
Right. So consumer staples
Yep.
only by 5.3,
right?
Only by 3.2, and information technology, interestingly, has become an essential service now, right?
Yes. It's with the technology that we're able to use Zoom and get on these conferences. So pretty much technology these days has helped us to catch up our daily lives with very little interruptions. People order food from online. Everything is related to the technology now. We have cell phones and the communication abilities. So that's why you see that the communication services, although it came down, there is that opportunities for growth in communication services.
Yeah.
I just want to chime in here actually in this issue. The healthcare companies and also the IT companies are also the ones with the least amounts of debt usually. Yeah, so they generally tend to fund their operations with a less debt usually. And energy sector, on the other hand, many of the companies were highly leveraged companies operating on debt. And so when a bad thing happens, when the demand falls, even during the last year, then the company's survival becomes even more difficult, and many of them file for bankruptcies. GE is a perfect example of how a very good company with a huge levels of debt can go down pretty fast because of the crisis. So healthcare companies, and I think in this particular situation, the IT tech companies actually benefited the most in the coronavirus, because it's a very unusual type of downturn where everybody is expected to stay home and communicate only through technology. And I think that actually gave a boost to the technology sector as such.
Right.
Yeah. Otherwise, healthcare by its very nature is usually the place where conservative growth always happens.
Right. And there is so much improvement in the biotechnology industry and the research, especially with the pandemic. Now there are plenty of opportunities for a lot of these bio research firms to come out with some kind of remediation or vaccination or therapies. Every avenue has been looked at as a solution to this pandemic.
Right. So at this point in time, there are enough questions on the chat. So I'm just going to devote a few minutes just on the questions before we go to the next section. And if you have any follow-up on that, please type them into the chat. So the first one is really just an observation, and Gopal and Shuk would love to take your take on it. And that is that it is predicted that the people retiring in the year of 2045 would only have about 40 to 50% of their social security benefits or Medicare benefits compared to the current compared to the people who would be retiring right away right now. What do you think? Is that line in the sand? Is that?
I think it's a fair assumption. I mean, the whole point of my initial thing was to make that assumption in the first place. So I have a feeling, like I said, that they are going to move the age limit also. It is definitely going to happen.
Wow.
Yeah, it is not a question of it's only a question of which who is going to have the political and the backing, or is it going to be forced on them? So it's definitely going to be a compromise that's going to happen.
Right.
But,
okay.
But everybody wants to make the pain too much, so they will do it more gradually. Then it won't be a sudden thing.
Wow. Okay. Thank you. And another question is, how is this downturn going to impact financial institutions specifically? And follow up to it is also, is the worst really behind us? I don't know. I know you guys don't have a crystal ball, but
right. But I can take this. I mean, this is not we are not behind the worst scenarios. There is still a possibility of more downturns, mainly, particularly talking about the financial institutions. Financial institutions are going to struggle, although the stimulus is going to help out consumers, utilize that money, and statistics indicate that other than employees who have lost their job, especially the hourly based workers, employees in restaurants, travel industry and leisure industries, and construction industries who have lost their jobs, maybe using the money, the stimulus money for their essentials. The rest of the people would be putting their money into it to be some liquidity into the stock market, and that's what they're expecting for a short-term growth. And there is a potential that within the next week or two, we can see some more upward trend in terms of the percentage of the markets coming up. But eventually it's going to start going down, mainly because there are significant loans and bankruptcies. Small business companies which are going to be struggling will be suffering a lot, and there will be financial repercussions just based on many of the industries which will take longer term to come up. So the financial institutions, especially the banks, will face quite some challenges to come back. And by then, if the unemployment ratio does not go down, and if it keeps increasing steadily, because initially they're expecting there will be 40 million people who are going to be unemployed by end of Q3. That would be an extreme risk to the financial institutions.
40 million? Wow. I don't know.
It's already 22 million.
I know,
Yes.
I know, but US entire population is 330 million. So how many people are working for 40 million to be unemployed? I mean, that's a lot of people.
Yes.
Are we talking about like one in 4, 1 in 5 being unemployed? Like 25?
Right now, they're saying about 1 in 5, but it could potentially go to 1 in 4. The reason is the repercussions are going to be slow. The recovery of many of the sectors is going to take longer. If you look at the travel, leisure industries, that it will be much more longer. They're expecting at least 4 to 6 quarters of negative growth on their side, it will be a lot of expenses. Many airline industries are burning cash on a daily basis. Even with the stimulus, it's being used towards expenses rather than revenues. They will not see any revenue for pretty much till end of Q3 this year. There can be some potential for some revenue to come up in Q4 and then going forward into next year, but that would just cause a break even for them. So for the travel and some of the industries to even start growing, they won't see light till almost a year from now.
Yeah. So I just put up a slide that some prediction, of course, on the types of jobs that are vulnerable and how many unemployment, how many people will become unemployed in millions in those sectors. Again, this is just some analyst's opinion, but even if it is like 10, 20, 30% off, it's still pretty drastic.
Yes.
Okay.
The thing is that these jobs which are lost do not come back overnight. That is the problem.
Exactly. Right.
Yeah. See, these particularly, for example, the travel industry is shedding all the jobs, right? So they're not going to bring back until they really see the demand pick up. And I think this year, based on what United Airlines have said recently, that they are going to see huge job cuts that they have announced, and they don't see the growth to profitability till next year. So which means that we are definitely looking at job losses and negative in those sectors. I think you still will not see huge announcement till the end of summer because they got the stimulus money and they made a promise to the government that they will not cut jobs. But once that money runs out, they are going to see that job cuts in those industries. And it's going to be like a very slow process over there. There's one small thing I want to add, Shiv Kumar, about the virus itself. I have a little bit of a positive take on that. And I feel like we would have some sort of a control over the virus, because what we have not done so far is we have not tested everybody who had actually been exposed to the virus but did not develop any disease whatsoever. A very small controlled study has shown that almost 1 to 100. So for every one person we have reported as infected, there are almost 100 people who were infected but never reported because they never showed any symptoms. If that number is really true, we really have a huge population who have immunity to this disease
and not know it. Yeah.
And not know it. And I think that would be another big factor. And the recent announcement from Gilead, which shows that a drug which is active can also protect people from getting the disease into the death stage, and it can stop the progression of the disease.
Right.
Those things also going to help in the controlling the virus, and those two will be very, very strong positive factors,
right,
which can reduce the topic of depression.
Right.
I don't think recession is still going to be taken away, but at least we can be sure that it will not be a depression, and these numbers of job losses could be much lower than what we are seeing here.
There are some more positive factors that I want to highlight, Gopal. That is, if I were to go back 100 years ago, when the industries were run by Carnegie's, the Rockefellers, and the JP Morgans, they controlled pretty much, 80% of the industries. And then the labor laws were not that great. When their, the bottom line growths were affected, they would just lay off employees, and the compensations were terrible, and employees and people used to suffer a lot. But now there are quite some labor laws, and the industry and the governments have learned good lessons. And particularly in this scenario, what has happened is companies are saying that they're not going to lay off employees drastically unless you are in some of the top industries that you have highlighted, like the food and beverage, like the retail industries. But other industries, what they're doing is furlough employees, saying, well, you may have to take some pay cuts, but at the same time, we will keep you employed. right? That's one good strategy. The second strategy is that many of them have been supported by their companies with many capabilities rather than being laid off completely and then being cut off with their basic income. So that trend that I've seen with many of the companies, and then that's what the industry is moving towards, and the country is moving towards, will cut down that unemployment. Although the 44 million I mentioned is going to be on the high end, there is a potential that if the companies start to think not to lay off and cause another panic in the global economy itself, it would be a good solution to think about.
Yeah, yeah. Thank you, thank you. So moving on to other questions. There are quite a few, and we'll try and get to as many. So one of the interesting question is, I'm just going to read it out. What are the risk-free type investments in USA? And I'll qualify that. So for example, in India, we have many, so-called risk-free savings schemes like Kisan Vikas Patra or NSC, National Savings Certificate, where money essentially gets doubled some number of years, let's say 9 years, 8 years, whatever, and it is guaranteed by the government of India. It's risk-free in the sense that it is guaranteed by government of India. So are there investments like that in the US? If so, what are they?
There are some private investment vehicles offered by some financial services with guaranteed rate of returns that match just the inflation rate more than anything else, with maybe very a low percentage of growth added to the inflation rate as well. But other than that, from a government perspective, there's not many, but then again, there are new avenues that have been in the US, particularly the investments related to your deferred growth, your retirement investments, the IRAs, the 401ks, the KEO, and other small business and business self-employed opportunities of deferring your taxation and income. And then putting them into some of the investment vehicles. There are bonds and other fixed income strategies which will provide some kind of an assurance and some level of growth relative to the equity market.
I see. Thank you, Shubham. So there is another whole set of questions, and I'm just going to compress them into a couple of bullet points, and they all will have similar answers. They are really about so we just talked about these asset classes and different sectors and so on. Some are national, some are international. How would one go about finding index funds or some kind of a vehicle that represent each one of them, and where would they go to find those? And we can share links, but if you could speak to where one might be able to go discover, for example, I think IT sector is good, so I want to invest in it. But how do I don't know individual companies. I want to be able to invest in a sector. Where would one go for that?
So there are several equity index funds, which basically, just as a simple definition of what index funds are, these include a group of stocks with similar characteristics, such as size, value, and profitability, and also depends on the geographic location of the companies. It's a group of stocks may include companies from United States that belong to a particular industry, right? So what we see is there are ETFs, exchange traded funds, which are tied to the index funds that are traded and offered by many brokerage companies and financial institutions. So one can definitely look into such institutions and organizations to get their account open and look into some of those long-term investment strategies.
Okay.
I just want to add one more here. I think most people have either Fidelity or Charles Schwab.
Okay.
Some of them may have Vanguard. The S&P index can be either bought as a whole index, the spider, or you can buy the individual sectors that Shivkumar highlighted in the previous slides. You can buy each one of the index as a separate ETF from all those places. It is basically, they give the same group of stocks and you can buy an individual sector of the S&P so that you can capitalize. I mean, if you're really particularly very interested on capitalizing a particular sector in this scenario, like for example, you want to go into the healthcare sector, but you don't know which stock to buy, but you would want to buy the entire healthcare sector, you can just buy the index, S&P 500 index, only corresponding to the healthcare sector.
I see.
Yeah, it's slightly less riskier than buying an individual stock, where you are concentrating on almost like 50 to 60 stocks which represent. Today, for example, Gilead went up because they came up with the best drug for coronavirus at this point, but you don't have to take that guesswork. So you would buy the S&P index for the healthcare, it will include that automatically.
Right.
And that's one big advantage of going with the sector. And the S&P 500 companies are really the best group of companies in the US, in my opinion, where a lot of your fundamental research has already been done by the S&P.
Yeah. So just to relate it to this this fund or ETF discussion, somebody pointed out that one should be cautious because some of the ETFs have excessive expensive ratios.
Yes.
Administration costs.
Yeah,
So,
Prakash is right, but that's what everyone has to look into. But if you look at overall, with respect to that expense versus the growth that is managed by a lot of these investment management firms, it's much easier to be in a managed fund like an index fund rather than doing individual trades. It requires a lot of time and effort for individuals. Unless you are in a job where you have that type of luxury to spend time and evaluate on your own, it is always worth to be invested in a market where there are funds offered. And of course, they do carry expenses, but then you can always work with the specific investment firm on those expenses.
Yeah, got it. So one slightly different kind of a question is: do either of you have an opinion on the potential risks of investing in cryptocurrencies?
Well, cryptocurrency, I mean, which involves the blockchain technology, right? There are many avenues. There are good opportunities, especially with respect to the use of blockchain technology, and which in turn gets into cryptocurrency. Going forward, I see that there is a significant usage for cryptocurrencies around the globe for many type of worldwide global businesses, and also within many activities where the transactions have to be tracked all the way from the source. For every change in the currency transactions that happen are encrypted and tracked and traced. So that's the benefit from a technology standpoint. It's almost like keeping a global ledger of the transaction. So that's definitely the next industrial change. It's going to be a significant turning point with blockchain and the cryptocurrencies.
So basically, just to kind of tease it apart, Shivkumar, there are two things there. I just want to understand which one you're talking about. There is the blockchain, which is the technology platform.
Yeah.
Companies that offer blockchain as a technology.
Yes.
Some of it is used for cryptocurrency. It's probably used for something else too. But then the actual Bitcoin type cryptocurrency themselves. So I guess the question is really more towards this, bent towards the second one. Should we go invest in Bitcoin? Do you have any opinion on that?
Certainly, it's something to look into from an investment standpoint. There are potentials with some Bitcoins, certain types of coin bases are going to continue to stay. The cryptocurrency is going to be an evolution. But we have to tread cautiously in terms of investing in cryptocurrencies as a currency by itself, purely, because it all depends on the trend as to how many companies, globally are going to appreciate the usage of cryptocurrencies, and how the current values of these currencies are going to get replaced by, gold used to be one of the key, right, currencies. And then eventually there was oil at some point, gold, and now the cryptocurrency is one thing that's going to be coming up soon. And there is a potential for growth, but again, where this growth is going to go, how many companies are going to accept this as, and how many governments are going to accept this form of a currency exchange is still a questionable thought.
Yeah.
And how many cryptocurrencies are going to be there?
Right.
Yeah, I think that makes perfect sense. So what you're really saying is that, it's interesting, but exercise caution.
Absolutely.
Yes. Yeah, it's very difficult. Unlike gold, where you can physically see it, it's it's very hard for something like this. And there are so many competing currencies, and some of them are internal to the companies themselves, and they are offering it. I think JP Morgan has its own cryptocurrency too. So they are specifically, unless otherwise something is backed by a consortium.
Yeah,
it's very hard to go with cryptocurrency as a safe investment.
Yeah.
Yeah, safety, I would question the safety of the investment at this point.
So more on the high risk.
Right. It's definitely on the high risk, and also the overhead in terms of the charge, the expenses are also on the high end, mainly because of maintaining the technology, the infrastructure associated with this technology is going to take a toll on the actual value of the cryptocurrency itself.
Yeah. Okay. There is another question really on a very specific segment, just to get your thoughts on this. And that is that, given the strong growth so far in the IT and especially AI segment, would it be wise to invest more favorably towards that, or is there any strong reason not to do that?
Well, the millennials are predicting, when I say the millennials, people who have been born from 2000 on, they're considered as the millennials or the current generation. They're expecting that within their lifetime, there is a possibility that they're going to go into space, right? So you see that there is significant investments in many of the space technology-based companies. Virgin Galactic is one of them. And well, when we see this AI and the automation and the trends around all that, here we are, with the high hopes, and that's what actually caused that peak, the January peak, where we saw almost 10 to 12% growth in the S&P 500 just within the beginning of this year, before the pandemic brought it down, right? So yeah, if you look at that growth, that was all attributed to the AI, the automations, and the improvements in the technology. But then we also have seen that besides technology, we have seen factors like a pandemic, which could take a heavy toll on economy, right? So we could be talking about so high-tech things, but then when it comes to a basic commodity like a mask, we struggle to make a mask, right?
Yeah,
so kannadaದಲ್ಲಿ ಗಾದೆ ಇದೆ, ಹೊಟ್ಟೆಗಿಟ್ಟಿಲ್ಲ ಅಂದ್ರೂ ಜುಟ್ಟಿಗೆ ಮಲ್ಗೆ ಇವು ಅಂತ, right? So we try to explore ourselves to be at the high end, whereas we miss some of the fundamentals.
Right. I mean, artificial intelligence is not going to make our masks.
Absolutely.
There is one hypothetical question, and that is, if we pay more in social security tax, let's say if we pay 7% social security tax as opposed to today's 6%, does that help future generations retain some of the benefits? It's a hypothetical. What do you guys think?
There are two ways actually the government has been constantly increasing social security contribution. One is by actually increasing the income base. So if you look at the income base, it has been constantly going higher and higher and higher. And that is one way they do it. They can also do it by percentage. So it is going to be both ways. So yes, they are going to take more from the people who are going to be wage earners than from other people. Yeah. So there's both ways. It's going to be like a constant number. Yeah. It's going to, I don't know if they're going to increase it to 7% contribution, But it is, it's another form of taxation only.
Correct. It's an indirect tax, but I guess it's an indirect tax on. Yeah, I don't know. Yeah, it's the same.
No, it's a direct tax.
Direct
It's a tax which is coming 1% from you and 1% from your employer. It is a taxation only. It is not. Both the healthcare insurance premium and also the social security premium, Medicare premium, everything is a taxation on the individual. It is nothing comes for free.
Yeah.
So it is a taxation. Yes.
Yeah. Thank you. Right now we are at the top of the hour of that what we had set aside for this discussion, and just looking to make sure that we are accommodating people's times. So there are a couple of more things that we have in the slide. So what we'll do is we'll just share them, especially around what help is really out there, for whether it could be unemployment insurance or how, what avenues exist for keeping your healthcare in case your job is threatened. There are some general government benefits that we can get, and some breakdown of where money is going from the stimulus bill and so on. So we'll share this deck. There's no point in belaboring some of these things. And I know there are more questions too on the group chat, but apologies, we'll not be able to get to all of those. We tried our best to make sure that we pick themes and sort of have umbrella questions to cover both of those. But of course, all of us are available for discussing it in the financial group in any case. So with this, I think, Ajit, we should wrap this up. I personally thank Shivkumar and Gopal for these.
Thank you, Harish, for moderating. Appreciate that. The questions were very valuable, and I hope it helped all our audiences.
Yeah, Shivkumar, I think let's go with our vote of thanks now. KKNY has took many initiative in this tough time to keep our community people positive and busy. And our community members have stepped up to help with whatever they can, like donating medical equipment, food, knowledge sharing, talent, money, etc. We are all together in this crisis time, and hopefully we'll get it through soon. Coming to this session, I thank all for joining the session, and it was really, really good. Thanks to Gopal for explaining the depth and the current market situation and how it is all affecting us. Now it is seriously, we have to think about the social security funds, what we think it is, and plan alternative for that. Thanks to Shivkumar for giving information on the current market trends, on where we are heading, and for portfolios. We now have some idea where to invest, of course, with our own caution. At last, not the least, Harish, the director, composer, and the great moderator we have. Harish sir, you did great job keeping the whole discussion flow in the right track and answering all the questions which we can. As you said, again, I think some of the questions which people have, they can reach out directly to you, or we also have a group which financial well-being, we have people can join and get more information, and we're going to share this all the information in other platforms also, so that people who missed or had more question can get more information about it. And thanks once again everybody for being here, and it's tough time, we'll get through it. So thank you.
Thank you, Ajay. Thanks everyone. Thank you.
Thank you.
Great job.
Okay.
Thank you, Harish.
Okay.
Thank you. Bye.
Thank you.
Okay.
Thank you, guys. Thank you. Bye.
Thank you.
Thank you, guys.
Okay.
Thank you.
There, done.
Thank you, Shivkumar, Gopal, and Harish.
Thank you, everybody.
Thank you.
Hi, there is iPhone.